Warren Buffett Blueprint. Investing for Beginners. Warren Buffett, often referred to as the Oracle of Omaha, is widely considered one of the greatest investors of all time. With a net worth exceeding $100 billion and a decades-long track record of market-beating returns, Buffett's investing philosophy is a blueprint for anyone aspiring to build wealth through the stock market. The good news? His approach is surprisingly simple and accessible for beginners. In this guide, we'll break down Warren Buffett's investment principles into actionable steps that you can start implementing today. 1. Understand the power of compound interest. At the core of Buffett's philosophy is a profound respect for the power of compound interest. Buffett once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." What is compound interest? Compound interest is the process where your investments grow exponentially because you earn returns not only on your initial capital, but also on the returns that your money generates. For example, investing $1,000 at an annual return rate of 10% will grow to $1,100 after 1 year. In the second year, you earn 10% on $1,100, not just your initial $1,000. How you can use this principle? Start investing early to give your money more time to compound. Reinvest dividends and other earnings rather than withdrawing them. Choose investments that generate steady, reliable returns over the long term. 2. Focus on value investing. Warren Buffett is a disciple of value investing, a strategy developed by his mentor Benjamin Graham. Value investing involves buying stocks that are undervalued by the market. How to identify undervalued stocks? Look for a margin of safety. Buy stocks trading below their intrinsic value, the true worth of a company based on its assets, earnings, and growth potential. Analyze financial metrics. Focus on key indicators like price-to-earnings, PE ratios, price-to-book, PB ratios, and free cash flow. Avoid speculation. Stay away from trendy stocks or businesses you don't understand. Buffett's example. Buffett's purchase of Coca-Cola in the late 1980s is a textbook example of value investing. He identified Coca-Cola as a globally recognized brand with consistent earnings and growth potential, but bought it when the stock was undervalued. That investment has since returned billions. Actionable steps for you. Research companies with strong fundamentals. Use tools like Yahoo Finance or Morningstar to assess financial metrics. Practice patience and wait for opportunities to buy great companies at a discount. 3. Invest in what you understand. Buffett's mantra, "Never invest in a business you cannot understand," highlights the importance of knowledge in investing. Why this matters? When you understand a business, you're better equipped to evaluate its potential and make informed decisions. Investing in industries or companies you don't understand increases the risk of costly mistakes. How you can apply this principle? Stick to industries or sectors you know well. For example, if you work in healthcare, consider investing in pharmaceutical companies or biotech firms. Avoid complex financial instruments like derivatives unless you fully grasp their mechanics. Conduct thorough research before making any investment decision. 4. Hold for the long term. Buffett's favorite holding period is forever. He advocates for buying high-quality companies and holding onto them for decades, allowing them to grow and compound over time. Why long-term investing works. Reduces transaction costs and taxes. Avoids emotional decision-making during market volatility. Capitalizes on the compounding effect. Examples from Buffett's portfolio. Buffett purchased shares of American Express in the 1960s and continues to hold them. His investment in Coca-Cola has spanned more than 30 years. Steps you can take. Identify companies with sustainable competitive advantages, also known as moats. Ignore short-term market noise and focus on the long-term growth story. Reassess your portfolio periodically to ensure your investments still align with your goals. 5. Prioritize quality over quantity. Buffett believes in owning a concentrated portfolio of high-quality companies rather than diversifying excessively. He once said, "Diversification is protection against ignorance." It makes little sense if you know what you are doing. What this means. Instead of spreading your investments thin across many stocks, focus on a few companies that you deeply believe in. Quality companies often have strong management, a recognizable brand, and consistent earnings growth. Actionable tips. Start by building a watch list of companies you admire and would be comfortable holding for years. Conduct in-depth research on each company's financials, management team, and industry position. Allocate more of your portfolio to your highest conviction investments. 6. Avoid debt and stay liquid. Buffett has consistently warned against the dangers of excessive debt, both for individuals and businesses. Why avoiding debt is crucial. Debt magnifies losses during downturns. It limits your ability to take advantage of investment opportunities. How Buffett practices this principle. Berkshire Hathaway maintains large cash reserves to weather economic storms and seize opportunities during market downturns. How you can apply this principle. Pay off high-interest debt like credit card balances before investing. Maintain an emergency fund to cover 3 to 6 months of living expenses. Avoid using margin, borrowed money, to invest unless you are highly experienced. 7. Stay disciplined and rational. Buffett's success is as much about emotional control as it is about financial acumen. He's famous for staying calm during market crashes and avoiding herd mentality. How to stay disciplined. Develop a written investment plan outlining your goals, risk tolerance, and strategy. Avoid impulsive decisions based on market headlines or social media trends. Remember that the stock market rewards patience and discipline over time. Buffett's advice: be fearful when others are greedy, and greedy when others are fearful. This means taking a contrarian approach, buying when prices are low and others are selling, and avoiding overhyped markets. 8. Continuously educate yourself. Buffett spends about 80% of his day reading and believes in lifelong learning as a cornerstone of success. What to read? Annual reports of companies you're interested in. Investment books such as The Intelligent Investor by Benjamin Graham and Common Stocks and Uncommon Profits by Philip Fisher. News and financial publications like The Wall Street Journal or Bloomberg. How to build the habit. Dedicate 30 minutes a day to reading about investing. Join online forums or groups where you can discuss strategies and learn from others. Stay updated on market trends, but don't let short-term noise distract you from your long-term goals. Conclusion. Start your investing journey today. Warren Buffett's investing principles are timeless, effective, and surprisingly straightforward. By understanding the power of compounding, focusing on value investing, and maintaining a disciplined, long-term approach, you can set yourself up for financial success. Remember, the most important step is to start. Whether you're investing $100 or $10,000, every dollar you put to work in the market brings you closer to achieving your financial dreams. Are you ready to follow the Warren Buffett blueprint? Start small, stay consistent, and watch your wealth grow.